Hey, hi everyone, and welcome to today's monthly webinar. So we're up to May 2024. Felt like just yesterday we were in the last one. Okay, so like always, today's session will be recorded and you will receive a link to the recording. So please don't stress if you need to drop out any time or you want to share the recording with a colleague. All our previous recordings are available on BGL's YouTube channel. If you do have any questions at all, please enter them there in the Q&A panel. Our lovely team from BGL are logged in and happy to answer any questions that you do have. So today's session, following the same format as always, I'll cover the first section, which is what's happened in the BGL world in the last month. And then joined as always for an SMSF update by Aaron Dunn, CEO and co-founder of Smarter SMSF. Welcome, Aaron.
Thanks, Javen. How are you?
Very good. How are you doing?
Not too bad, thank you. It's a bit of the calm before the storm leading into 30 June. So I'll touch a little bit about federal budget, which of course we saw recently, and probably as much as what we didn't see as much as what we did see. But yeah, there's a few interesting gems in there for everyone.
Excellent. Okay, and then like always at the end, Aaron and I are happy to cover any questions that you do have and or a recap of some of the questions that have been asked. Okay, so let's get first of all into the BGL update. Okay, so our last update we released was on the 2nd of May, and our next update is actually going out this Thursday, which is will include some of the tax changes, which I'll cover off just a bit later. So our first couple of changes were really based around just standard, I guess, SMSF updates around contributions and pensions. So I won't go through and demo these face to face, but all the contribution limits were updated by the, I suppose, increase in limits in the last, obviously the last 12 months. So for FY25, you will find all of those updated. And this has been updated in every single dashboard across Simple Fund 360, every single report, and every single place that you do find contribution information. So you'll find everything that has been updated now for the obviously increase in caps. Same with pensions. Obviously, there's been no change across there from 24 to 25, but we've updated and made sure everything's in place there for 25. So again, every single dashboard's been updated and ready to go. Every single report, every projected report, etc. Now updated there for the 25 financial year and ready to go with that. So first change we've now released there in the software is any actuarial certificate that you do or do order through Simple Fund 360, you're now able to include as part of a report pack there on the report screen. So I'll jump across and let's have a look at that. Okay, so going across there to the report screen. So what we'll do first of all, I'll add in a couple of standard reports. So go through there. So we'll search through for the actual actuarial certificate. So I'll add that in. So the actuarial certificate, it'll grab it there directly from the pensions policy screen. So grabbing that directly, and I'll go through and preview that. Okay, so you'll find then it's included there as part of the one there. So I've just got obviously a sample one of included as part of that. So you can obviously add that as part of your report pack, so including those going out for digital signing. Okay, so the next one there is in terms of our practice management integration. So our practice management integration now supports APS. So in terms of the different practice management software that we do support, that's Xero Practice Manager, MYB Practice Manager, which was formerly GreatSoft. We're soon to support MYB Advanced as well. And obviously APS has been added to that. The way that works is when you first connect through to APS, all the clients and contacts are downloaded from APS into BGL. They're then linked against existing BGL's entities. So that's across both Simple Fund 360 and CAS 360, as well as the contacts. And where all the data matches, they'll be linked together. We'll then, obviously, where data does not match, we will then display errors and get you to correct those errors so they are in sync. And then you'll have the option in terms of updating existing contacts of that integration of being either one-way or two-way, where, for example, if you update a client or contact within APS, it will automatically update in Simple Fund and prepare a change form in CAS 360 where you are utilizing CAS 360, or where you do have the ability, for example, to push new clients through from one software application through to the other. The next update we've done there is to account view. So obviously we've made some changes back and forth over the last sort of few months based on user feedback. So going backwards with this one is the account view can be accessed there on the report screen, which we're on now, which is that tab there, or can be accessed from any screen. For example, if you are on the transaction screen, you can bring that up automatically directly there on screen, and obviously just hit the escape key to go back if needed. Let's go close that out. So going back to the actual account view, we've now changed it to a collapse view by default. And you do have the button up top there to expand all sub accounts and display those accordingly. From there, for anyone who hasn't utilized this screen before, you can drill down onto accounts so you can find more information and obviously export the list of transactions there out to Excel. The other change we've made is across on our Smart Report screen. So the Smart Report screen, you can now export the operating statement out to PDF directly from this screen. And obviously on that screen, you can go back and compare multiple periods. And also on the balance sheet can be generated there on screen, and that will be coming soon through there as well. Okay, so that's all the major changes that were released to that one. So coming soon, as I said, we are releasing an update this Thursday, and that includes the following changes you can see there on screen. So the SMSF, 2024 SMSF annual return has been updated. That's I suppose the good news. Nothing has directly changed in the actual tax return portion itself. For all entities, so that's trust companies, public partnerships and SMSFs, there is a new schedule which now needs to be attached to the actual tax return itself. So that's any trust that in this case, let's say the SMSF receives income from, and the definitive trust will include items such as actually trusts themselves, whether that's a listed trust, a private trust, for example, closely held trusts, and then other forms of trust structures such as exchange traded funds, so ETFs, managed funds, property schemes, etc. So any trust income that has been received, a new trust income schedule will need to be displayed. This will be very similar to the annual tax statement that gets actually received directly there through to the investor. That really a copy of that is pretty much being calculated, I suppose, entered through and attached through to that relevant schedule. So in terms of your data entry, not a lot changes. So you're still using our either distribution automation screen, or you are utilizing either a data feed or directly entering that data information in. It will still be populated through for the tax return, and the schedule will be automatically created. So the additional work in terms of populating that will be very limited. Where it will become, I suppose, messy is where you do, I suppose, the SMSF has multiple investments that have a trust structure, is that there'll be a schedule for each individual one. So let's say there's 20 different investments that have been invested in, you'll see 20 different ones there. In terms of a managed portfolio, so the example might be a wrap up platform, there'll just be one particular schedule that need to be completed. But please come along to our next webinar. We can give a practical demonstration of this and how it works. Across in Simple Invest 360, where you can now prepare a family trust election and lodge that, which can be done in conjunction with the tax trust return there at year end, or it can be done independently there as well. So look, that's something we added from this Thursday. So in terms of the BG updates, that's the ones coming, I suppose, we are working through. In terms of later in June, I don't have an exact date yet. We will be releasing, obviously, with Simple Invest 360, the 2024 company tax return and trust tax return there as well. Okay, so in terms of the BGL update, that's everything that I will cover. So I'll pass over now to Aaron. So I'll just give you control, Aaron.
Yep. Excellent. Thank you, Jeevan. Well, as I said at the beginning today, I just wanted to provide a bit of an update around the budget. It was relatively quiet, and I think from a superannuation point of view, that arguably leads to what is going to be quite significant from an election standpoint next year. So the current Labor government hasn't really looked to make significant change to superannuation. Some might argue, well, what's Division 296, Aaron? Well, their technicality would say, well, we're not seeing that introduced until after the next election. So it is going to mean that policy settings around superannuation, and we know the coalition government have been quite forthright in maybe using housing for superannuation, and we, of course, have the objective of super as well, sort of sitting behind it with the Labor government, means that the next 12 months we're going to see a lot of airplay on superannuation generally, but in this particular budget, things were relatively quiet. So the couple of areas that I'm going to touch on that we did see, one was around paid parental leave. So where someone is in receipt of government-funded paid parental leave, we did see now as a policy statement the fact that superannuation or compulsory superannuation is going to be paid on that paid parental leave from the 1st of July 2025. So it'll apply to babies born or adopted after that date. And interestingly, the payment will be made annually, meaning that there is a deferral in terms of the timing when that is made. And naturally, the 1 July 2025 date aligns with that indexation up of the SG rate to 12%. Now, what is quite interesting out of this is the fact that this is something that the Greens have made very clear that they wanted introduced if they were to provide passage to the Labor government around the Division 296 tax rules. Those Division 296 tax rules, of course, being the additional tax on high balances above $3 million. And I just put a couple of extracts for you here. The bottom left is their policy announcement, or their media release, I should say, in September of last year. And they basically said that if you don't give us the ability to pay superannuation, mandated super, on paid parental leave, then us as an organisation, being the Greens, we are not going to support, and we will basically stop the ability for these Division 296 measures to come into play. So interestingly, what did we see in the budget? This measure, and they argued, the Greens said, well, look, this will take about 10% of the overall revenue that's going to be collected through this on this paid parental leave. So we have seen that rolled out. More interesting recently, though, is the Greens look like they're going to have another bite at further change. Now, whether they're successful or not, but I do note in the finalisation of the Senate Economic Legislation Committee report around the Division 296 measures, the Greens have said, well, we would like to also see a reduction from the $3 million to the $2 million, which interestingly from 1 July 2025 will be where the transfer balance cap is based upon current indexation rates. And they would also like to potentially see the removal of limited recourse borrowing arrangements as well. So again, these are just things that have come out in the final report. It has gone back into Parliament at this point in time. So we are currently awaiting finalisation of the bill going through the House of Reps. There were some amendments that were proposed, but Labor control that. We do know that it is in the Senate that the decisions will ultimately be made as to whether this legislation goes through or not in its current form. So at this point in time, with very few days left before 30 June, it is very much a wait and see to what gets finalised. But just noting that the announcement in the budget around this superannuation on paid parental leave was very much intrinsically linked to these Division 296 measures. The other thing we all knew about was, of course, the changes to the Stage 3 tax cuts. And the only reason I put this in here for you is just to start thinking about what clients might be impacted by with these changes. So much older clients that may be looking to draw more than those minimums out. Jeevan obviously mentioned in his session about the fact that there's no changes to the minimums. factors, but we also know that the rates are much higher now, back to where they were. So some of the clients may not have ever have seen, other than this first year, those 50% reduced rates that we've seen over that sort of 4 or 5 year pandemic period. So making sure that they understand the balances between how much you have inside and outside, and that tax rate at 16% now very much looks like what they would be paying in accumulation inside superannuation at, say, a 15% rate. So most people are going to have more money in their pocket. So things like salary sacrifice, of course, are going to be certainly very relevant in that situation. Thinking about even transition to retirement strategies. And again, going back to that thinking between where money may be held, in particular with superannuation death benefits tax that sits on top of that, are all things that should form part of the ongoing discussions that you're having with your SMSF clients and clients more broadly. The other parts here that we saw was a freezing around the deeming rates for age pension and Commonwealth Seniors Health Card. So this again is part of the cost of living measures, helping those that qualify here so that their assets are not, I guess, bumped up, and therefore would reduce the benefit that individuals would receive either by virtue of age pension or their entitlement to the Commonwealth Seniors Health Card. So it is worth noting that these deeming rates have remained frozen at the 0.25 of 1% there, and then 2.25% thereafter, subject to whether they are singles or couples and so forth, through until the 1st of July next year. So they're really the main two. So I'm usually one that sits down and might spend a fair amount of the night thinking about, well, you know, how long am I going to be working on the budget papers? So Jeevan, I reckon I was literally, I might have even cracked one can of beer open or opened, you know, unscrewed the bottle top of a glass of wine, a bottle of wine, and it was pretty much done. So, but when we think about what we wanted, some of these things still remain unresolved as well. So we're still waiting on the government to deal with the residency announcements that had happened previously. So two aspects to the residency announcements. One was that they were going to remove the active member test, so the third limb around residency that really put SMSFs on level footing with other APRA-regulated funds. And the other part to it was expanding the temporary absence period around central management control from 2 years to 5 years. So that is awaiting to see whether that does or doesn't come about. The other part was our legacy pension conversions, and this had more urgency to it than, I guess, the residency rules did. And as an industry, we really pushed hard for this because of the fact that we know defined benefit pensions in the construct of these Division 296 tax rules is going to be really problematic. So the 2-year amnesty or conversion period was going to be important to allow people to effectively roll out of these pensions if we wanted to simplify what the approach would be. Arguably, we're going to have to see valuations done on these pensions each and every year as part of that actuarial process, not only solvency, but determining a value around whether then that member's benefit would be subject to the Division 296 tax rules. So there's more complexity that's going to be added to these, and therefore creating a solution to unwind these was going to be really important. And again, we know that the government isn't ignoring this as such. So we did get confirmation that it is still there to be looked at. It's just not high naturally on their priority list. So we do need to just wait and see what transpires in future budgets around these two particular areas, or whether we see, I guess, information provided by Treasury, most importantly around consultation and exposure drafts, to then hopefully get these two items resolved, because they have been now lingering for quite a few years. The other part to this process is that we were waiting on the fact that for the 24-25 year, we had known that the inflationary impact of the transfer balance cap wasn't such that it moved the needle of the transfer balance cap from 1.9 to $2 million. But we did know that the Awati figure, so our wages figure, did increase the concessional cap from 27.5 to 30. And Jeevan showed you in one of the screens in his part of the session today that changed, effectively increasing the concessional cap, and what flow-on effect that has in terms of our non-concessional contributions too. So we were hoping that we wouldn't see any type of freezing around these things. And of course, that didn't transpire. So we do now know absolutely that our concessional rate moves to 30 from 1 July 24, I should say, and the non-concessional. And also noting that because of that indexation of the non-concessional cap, that we also need to think about our bring forward periods and the transition that relates to it being either a 2-year or 3-year period as well. So these thresholds on the left-hand side that you can see have all moved because of the fact that 110 has become 120, 220 has become 240, and 330 has become 360. And the final thing I just want to note on this particular topic is to remember that if you have already triggered a bring forward period already in this year or potentially in the previous year, you must complete that period first before any uplift of the indexation applies. So, i.e., if you've already triggered a $330,000 bring forward in the current year and it needs to still play out in the next year and maybe the year thereafter, they are locked into that 330 period until that cycle is completed. They don't get the uplift of the additional $30,000 that applies in essence from the 1st of July 2024. So just a really important thing to note there, because a lot of times we look at the headline figure and need to remember that it's the time in which the bring forward was triggered. We must see out that period first. The other items I think that are just worth noting from this is that from the 1st of July 2024, we see the low rate cap ultimately being removed. So 1 July 2024 means that anyone born after the 1st of July 1964 will be subject to a 60 years of age preservation age. So that now means that the retirement definition for all of our clients becomes a much simpler process as well. So we're not looking at that, what was previously 55 to 59 years of age, where we had individuals that had met a condition of, the condition of release was met where they had intended on retiring and therefore were not seeking gainful employment of more than 10 hours in a week. So that really has gone, and we're now simply looking at, from the 1st of July 2024, individuals 60 years of age or older. So we still have our second requirement here, that's 60 to 64, where we are predominantly looking at the cessation of employment concept. So cessation of employment, where you might have multiple employers and they cease one of those employment arrangements, or they cease employment and effectively move into retirement. So again, just noting the fact that 60 now is that date for the condition of release, but we do have a much simpler framework now to operate in, because anyone below 59, so i.e. born after 1 July 1964, will now require that age 60 preservation age. So that's pretty much it from me there, Jeevan. The one thing we do have coming up, of course, is our SMSF online masterclass. So that's next Tuesday for anyone that BGL users that would like to come along. We do have a 20% off coupon code that you can see there. You can register, join myself and Tim as we look at the topic of property and LRBAs. Anyone that's been to either our masterclass or SMSF days will know the format that we run around sort of case studies and an implied level of knowledge. So again, make the most of that, and hope people can potentially join us. Provides 4 CPD hours as part of attending the particular online masterclass.